Good morning. Welcome to Trading Hour. I'm Reema Tendulkar, with me Sonal Bhutra, and I think now the bulls are getting that Friday feeling, right? There's been a phenomenal recovery in the markets in the last 45 minutes or so. The Nifty from the day's low has recovered close to about 250 points. We're now back above 25,300, up 80 points. The Sensex is inching up towards a 350-point rally. IT is leading from the front. So the top sectoral index, which is up today, is IT. The Nifty IT index is up 1.5% with names like Infosys, LTI, Mindtree, Wipro, Tech Mahindra. Across the board, buying emerging ahead of results next week. Next week on Thursday, both Tata Elxsi and TCS report their Q2 numbers. But outside of that, banks, that's where the outperformance is. So after 4 days of losses on the Nifty Bank, today you are seeing that reversal on the Nifty Bank, and the Nifty Bank is up more than 500 points from the day's low, and it's Axis Bank, Kotak Mahindra Bank, and PSU banks too are doing pretty well. In fact, the Nifty PSU banking index is outperforming the benchmark banking index, and names like Bank of Baroda, where the Q2 update, quarterly update, look good both on advances, and there's a bounce back after the sluggishness of the prior quarter. BOB is the one which is pushing PSU banks higher.
So a lot of quarter two updates, of course, which are pushing the markets higher. And this is not something which was largely expected, because we did see some flattish moves on the negative side on the markets today. But look at the recovery, 250 points from the lows of the day. And if you look at some of the sectoral movers, of course, Reema spoke about Nifty IT. We have the metal index, which is doing well again, the CPSC index that's doing well. So the likes of ONGC, you have Oil India, all these stocks on the back of higher crude oil prices, they are doing really well. So Oil India, for instance, is up around 4%. ONGC is one of the top gainers. That one is up around 2%. Mid caps and small caps, both of them doing well today. So the mid caps up 90 points, and the small cap index, that's sitting with gains of around 0.2%. So the recovery has been seen across the board, barring some of the sectors which continue to see some profit booking. But we have to talk about the financial space, because Bajaj Finance and Emami Finance also released their quarter two business updates. Abhishek has the fine print.
To begin with Bajaj Finance, the new loans are up 13.6% YOY, and they have declined by 11.7% sequentially. The customer base is up more than 20% YOY and about 4.5% sequentially. Deposit momentum has been strong, growing at 20.5% YOY and about 5.3% sequentially. However, the AUM growth, now that's one of the weakest in last many quarters. It has come in at 28.8% YOY, which is the weakest that you are seeing in last 6 quarters, and it is up 5.6% quarter on quarter, which is the weakest growth that you are seeing in last 9 quarters. Cross-sell rate that I calculate is the lowest in any Q2 of last few years, X of Q2 FY21, when the COVID had impacted the industry as a whole. So cross-sell rate has declined for them to 6.2% versus 6.5% on a YY basis, and about 7.4% in the previous quarter. With respect to Emami Finance, the disbursements have been very weak. They are down 1% YOY and up about 3.3% quarter on quarter. The assets have grown by 20.3% YOY and about 6% quarter on quarter. This suggests that disbursements to AUM ratio might be on the higher side, and that tenure might have got adjusted, due to which the AUM growth has been seen. Gross NPA has deteriorated, as gross NPA ratio is now at 3.8% versus 3.56% in the previous quarter. Liquidity has inched up to 8,500 crore, which is up about 6.25% on a sequential basis. Back to you.
So those two quarterly updates from the financial space were a bit of a miss, Emami Finance and Bajaj Finance. But HDFC Bank also came out with their quarterly update for the second quarter. Abhishek, how did the numbers look? And also the shareholding pattern has been out for the quarter of September. So does that mean the FIs have more headroom to purchase?
Well, yes, Reema, FI do have more headroom to purchase. Now, to begin with the quarterly update, it can be clearly seen that they are focused on credit deposit ratio, and deposit momentum has been very robust for them. So take a look at deposits. They are up 15% YOY and about 5.1% quarter on quarter. Time deposits over here have grown by 19.3% YOY and about 6.7% on a sequential basis, which is a strong momentum given the fact that there is fight for deposit in the system as a whole. Now, advances have grown by just 7% YOY and 1.3% quarter-on-quarter. We have seen many news in the quarter gone by that they are, selling down or paring down their loans. So, AUM growth is at 8% YOY and about 2.3% quarter-on-quarter. Credit to deposit ratio, that's been their focus area. Now, that's down to 100.8% versus 104.5% in the previous quarter. Liquidity coverage ratio, a key metric, has improved to 127% versus 123% in the previous quarter. Now, HDFC Bank has released their September holding as well. So, FI headroom indicates that there is second tranche likely to be in the November review of MSCI. So, HDFC Bank September holding does show that foreign ownership limit is now at 55.5% versus 54.8% in the previous quarter, that is as of end of June. So, weight increase of HDFC Bank is a discussion of, index manager over there. Back to you.
Okay, all right. So that is about HDFC Bank. That stock also recovered sharply from the lows of the day, sitting with gains of around 0.2% as we speak. The other stock on our radar is Avenue Supermarts. This is under pressure following Q2 business update, which has failed to impress the street. Mangalam is joining us with the details and the analysis here. Mangalam.
Well, it's a soft quarter for Dmart this time around. It's a 14% revenue growth that they've reported. The reason why a 14% number is soft is because, one, last quarter they had about 18% in terms of growth. And if you look at the second quarter itself, over the last 3 years, the 3-year compounded average has been around 16% itself. So this 14% number in terms of growth and an absolute number of almost 14,000 crores is not something that, the street is very happy about, as a result of which the stock is lower. Add to that, over the last year to now, the store addition itself has been over 12.2%. That implies that the same store sales growth is around 1 to 2% as well this quarter, and that may have a bearing on the operational performance of the company in the quarterly results that they report. In this quarter, they've added about 6 stores. The previous quarter was around 6 stores, taking the first half total store additions to 12. Remember, Dmart adds the most amount of its stores in the fourth quarter. They've guided for around 40 to 50 store additions every year as well. The key thing to track now in the second quarter numbers, I would say 3. First is the gross margins, what happens to the product mix. Secondly, the pickup in their e-commerce business via QCom in Dmart Ready. And the third thing would be, was this slowdown on account of any sort of technical software related change that the company was doing, and is that likely to come back or not, is the big question.
Thank you very much for that. So those were the big updates in terms of prepping you up for how the quarter might shape up for the financial and even the consumer sector. Get into a break. We'll discuss commodities on the other side. Manisha Gupta joins in. Stay tuned.
Welcome back. Well, steady at those levels. Nifty is at 25,317. So at least steady above the 25,300 mark. 220 points recovery is what we are seeing from the lows. Nifty IT and the Bank Nifty is the one which is leading to the gains that we are seeing. Sensex also has recovered around 733 points. Nifty IT around 750 points. And the Bank Nifty, that is the one which is up around 450 points from the lows of the day. Well, it's not just the equity markets which are doing well. Crude has continued to do well. So let's talk about the commodity space. Manisha is joining in, and we are focusing on crude oil prices. It's up and away here.
Oh, absolutely. If you had to name something for the commodity of the week, it absolutely is the crude oil prices. Up 5% in the overnight market. It's trading at a 1-month highs, and we have seen this as a best weekly gain since Jan 2023 there. Well, the crude oil prices are still holding around that 77.5, and with that, for the month of October, we've seen the prices gain up by nearly 9%. The month of September saw prices decline by 9%. So you clearly can see on the tables have turned around in sense of buying positions being created here. There are various reports, and I've been reading most of them, which suggest that if the situation in the Middle East and between Iran and Israel continues to, escalate from here on, then you are looking at a possibility of prices at 80 and beyond. For that to happen, it would be that Israel attacks Iran oil facilities, or it happens that the oil export area that Iran has, Israel makes some kind of a demolition on that. Remember, 1.8 million barrels per day of export is what Iran has done for the month of August. And then there are possibilities of Iran stopping or disrupting the flow out of Strait of Hormuz. Now, this is a very important point. 1/3 of Middle East, 1/3 of the global crude production happens in Middle East, and that does flow through Strait of Hormuz. So if that happens, you could be looking at prices running up quite strongly as well. If you look at the crude oil price range itself, last year was between 93 to 73, and that's the kind of range that we've seen in this year as well, anywhere between 91 to 70. And with prices trading at around 76 or 77 is way off the kind of highs that we have seen in this year. That is because the supplies are much higher than the demand, and actual disruption in sense of oil facilities till now has not happened. Going forward, the markets will also be looking out for the US non-farm payroll data that comes in today, and the street is keeping a keen eye on all developments from the US ahead of the presidential elections there, and the US will not want crude oil prices much higher. So it's going to be quite interesting on what we see in the next 1 month in sense of all of these factors.
Thank you very much for that. Undoubtedly, crude is the commodity of the week. Get into a break. We'll come back and discuss market technicals. Sudeep Shah from SBI Securities joins in. Welcome back. Now, the recent FI selling has sparked off an India versus China debate. Hormus is now joining in with the latest on, and he's done some number crunching. Hormus.
You know, these last few days, the fall that we have witnessed in the Indian markets, one of the biggest factors has been the relentless selling from the FIIs in the cash markets. Yesterday was one such incident, almost $2 billion worth of selling. There have been many analysts who have come up and said that money is moving out of India into the Chinese markets, and the graphic that comes up on your screen now will be proof of that. Before going into the holiday season, the Chinese markets, the CSI 300 index, between the 18th to the 30th of September, that 9 trading sessions that they had, the index was up 27% from almost at a 52-week low, jumping to a 52-week high during this period. In contrast, over the last 4 sessions, ever since the Nifty made a record high last Thursday, since then the index is already down 4% from those levels, 1,000 points down on the Nifty, and the fall in the broader markets has been much worse. So there has been an outflow of money into the Chinese markets. But is this the start of a bull run in China and not so much in the Indian markets? Well, not many on the street are convinced about this rally in the Chinese markets, and Rajiv Jain of GQG is one of them. And he mentions very clearly that how many times in the last 3 years we have seen this excitement only for it to peter out in the months ahead. And he also mentions that if this party in the Chinese markets goes on without them, they are fine with it, and that's because Rajiv Jain in his funds have been underweight on the Chinese markets. And he said that this is a trade, a good trade at that, but is it investable for a 3, 4, 5 year period? That is questionable. Citi came out with a note and they mentioned that the CSI 300, as I just highlighted, was up almost 30% during this session. Multiple policy announcements that were supportive of this rally in China. But this recent outperformance has made sure that the Chinese markets have caught up with India in terms of performance. But in the Indian markets, the strong macro outlook and the flows from domestic investors will ensure that the markets remain resilient going forward as well. And Gavekal Research also came out with a view. They said that even if this China rally sustains, many foreign investors are reluctant, and they remain reluctant to invest there. And the headwinds in China will become tailwinds for the Indian markets going forward. And although they put in a caveat saying that while these foreign investors may find better value in terms of a lot of other emerging markets compared to India, but it is too early to call time on India's bull market.
Okay, so too early to call on time for India's bull market. Thank you so much, Hormus, for joining us with all those important details. In fact, we spoke to a whole host of experts on what they make of this India versus China debate. Here's what they have to say.
What we've seen so far is a commendable delivery on the monetary policy side. We've seen some direct stimulus at getting the equity market animal spirits back alive, and certainly the retail investor has followed through on that. What will differentiate this one is if in the next weeks and months we get some clarity from the Chinese government, from the key policymakers in the Politburo, as to the magnitude and the scale and the deployment of a large fiscal package. Because let's remember, I mean, China's single biggest problem that it faces at the moment is immense oversupply on the real estate side. And you need a sizable fiscal package aimed squarely at local governments.
Actually, I don't think it's a bad thing if China market does well for us, as in mostly for India. It is not bad for India per se. I don't think that beyond some shorter term thing, investors have to sell India to buy China. Because India, I don't think in aggregate, people are overweight. There might be 1% plus minus overweight. So if you were underweight China, that would have come from the rest of the world. India and China, even an emerging market fund combined would be, say, 20 and 25, 26 now. So half the investment of people who are able to move this around is in non-India, non-China.
Even though flows to India funds have definitely waned, they haven't gone negative, and I think India remains in quite a healthy position. It looks to me, at least from this week, that investors were pulling money out of liquidity funds in Europe to fuel this rotation.
All right, those are some expert opinions coming in on that India versus China debate. We'll keep getting you more updates on this one, but it's a good time to get a technical check on the market. Sudeep Shah from SBI Securities is joining in for just that. Sudeep, good morning. Thank you so much for joining in. A sharp recovery from the lows. Will we see higher levels from here on? Sudeep, I think you're on mute.
Yeah, good morning, Sonal. Absolutely. Now, post this 4% fall in the last 3 sessions that we have witnessed in case of Nifty, index has taken support at this crucial zone of 25,000, 25,100 band. And now this rebound is giving us signals that, yes, there could be some additional, say, move in the next couple of days, at least till Monday or Tuesday. And we could rebound back till 25,500, 25,550, given the fact that IT, pharma, metals, all these 3 sectors are showing good traction on the upside. And the real issue is coming with Bank Nifty here. 52 350, 52 500 band could act as a stiff resistance. So for the entire market to be into a rebound mode, we feel 52 500 on Bank Nifty will be the key from here on, and that will determine the entire medium-term trend from the current levels.
Hi, Sudeep. Morning. What about stocks? Any stocks that you have on your radar that you would recommend?
Yeah, a couple of them now. The first one is from the IT pack. We've seen a good recovery in the IT stocks from lower levels. Like last couple of days, there was some profit booking. But yes, for today, there's a good recovery. And Infosys is our top pick at 1935, 1940 currently. We feel that the stock in the last 6 to 7 sessions has consolidated enough and is trading at a decent level compared to what it was a couple of weeks earlier. And the daily, weekly and the monthly charts are suggesting that we could see a stable up move from the current levels. So till the time 1900 is held, we feel that this stock could move up to 2000 levels. So we can buy this with a 1900 stop loss for a 2000 target on the upside. The second stock that I have on my radar is MCX. Now, even this stock is in a long-term uptrend. Last few sessions where the markets have corrected from higher levels, this has relatively outperformed 5,700, 5,680. This zone has acted as a strong base. And today also we are seeing a good buying support from the lower levels. So I feel this outperformance could continue here. And this can be bought with a stop loss of 5,800 on the downside for a target of 6,100, 6,150 in a short to medium term time span.
Okay, all right. Thank you so much for joining in and have a great weekend ahead. Looks like so far it's been a good Friday for the bulls, but we'll slip into a short break. Up next, we'll discuss the market fundamentals with Puneet Sharma from White Space Alpha. Stay tuned for that conversation. Welcome back. You're still tuned into Trading Hour. Well, good contribution coming in from the IT pack and the Bank Nifty as well. So Nifty continues to trade higher as we speak. So it's a good time to talk about fundamentals of the market. Puneet Sharma from Whitespace Alpha joins us now to discuss the fundamentals and also some of the top sectoral bets. Puneet, good morning. Thank you so much for joining in today. We saw that big fall yesterday. Now we are talking about a recovery. We have this China versus India debate as well. What is your take on the Indian markets right now? Any sectors that you are liking in particular?
Good morning. Thank you for having me here. So in terms of the market currently, what is happening in the market? Obviously, after the large fall yesterday, it's good to see that the market is actually recovering a little bit today. In terms of fundamentals of the market, I think it's still a very strong bet that we have on the India story. In the long term, the India market is expected to deliver between 12 to 15%, and that's what we are banking on. Obviously, there will be small variations in the market on a day-to-day basis, on a week-to-week basis, but that's something that the investors in the equity market should not really be too worried about in the short term. In the long term, as long as they're picking up stocks which are fundamentally secure and participating in industries which are fundamentally on a very robust platform, they should be okay in terms of the returns that they're hoping to make out of that investment.
Okay, so as far as it's the long-term take on markets, it's fine when it comes to Indian markets as well. So which are these long-term bets for you, Puneet? Where are you looking at investing? Or do you think there could be more correction which is needed and that is when you would like to put in your money?
So currently, obviously, the market has been at a very significant bull run. So it is at a high, it is at the PEs, which have probably been closer to the all-time highs of the Nifty 50. So is that a good buying opportunity at the moment right now? I don't think so. There could be a further correction in the market, especially given what's happening in the rest of the world, including what's happening in the Middle East right now. So if there is an escalation in the war, there is escalation in the crude prices as well, it could provide a lot more opportunities for investors to get into the market and invest in the equity. Will there be specific sectors specific to benefit out of all what's happening in the market and the expected rate cuts, which are on the anvil now? There will be, obviously, banking is something that we are very bullish on. IT is again a sector that I think is going to do well in the long term. It's showing some small green shoots right now. I would expect IT sector to do pretty well in the decently medium to long term.
Okay, IT sector is one which you would expect to do well in medium to long term. Is there any place where you're waiting for a correction, Puneet? IT, of course, has run up a little and the consensus is that it could continue to grow from here on or see returns, better returns from here on. Is there any place where you think is good in terms of growth, but valuations are not supportive at these levels?
Right now, I think FMCG is a sector that I would probably categorize into this category where we would want to see a little more correction happening, especially given that the demand scenario right now in the FMCG side is not that great. From whatever that we are hearing from the market, the demand of products in the FMCG sector, especially companies like HUL, ITC, Dabur, Britannia, etc., they're not as strong as they were expected to be. With the rates cut coming in, probably these sectors will become more lucrative. But as of now, I would expect them to face a little bit more heat in the market, have a bit more of a correction before we start entering into these sectors.
Okay. We have this big China versus India debate which is going on. I just wanted to understand, one, if you would look at any of these international markets, and two, if China would be one of them, because we've already seen a 27% rally before there was this long holiday in the Chinese markets. Do you think this is the start of the bull rally that everyone's been talking about?
There have been numerous bull rallies which have happened in the Chinese market in the past 1.5 years or probably about 2 years odd. So ever since they opened after the 2022 COVID pandemic that was ravaging through the country in China, I think there were times when the market suddenly ramped up, but it's not really been a sustained rally in the Chinese market. So I'm not really certain that this is going to be another sustained rally in the Chinese market right now. It's just a reflection of what's happening in terms of the regulatory changes and the support from the government which has come in. The stimulus package is going to run out after a little while. So the economy needs to catch up in order for this kind of a growth in the Chinese market to be consistent. And if there are indications that the economy in China is going to be robust enough for such a growth to happen, then yeah, something. Investments in the Chinese market, especially on the real estate side, are pretty risky at the moment. So we'd be more of a wait and watch. Although in our fund, we are very focused on the India market. So our expectation is that the Nifty 50, that's the bellwether, that's the index that we are focused on, and expect that index to deliver the kind of returns that we want to deliver to our investors.
Okay. You know, one of your strategies is the momentum strategy. It does work in times. It must have worked a lot because the last few years or the last few quarters were very good on the upside. But do you think this is something that would work now as well? Because now it could be very volatile from an index perspective.
Right. We call that strategy our momentum strategy, but we are very neutral to the market overall. So we will have positions in the derivative market on either side of where the market is. Trying to make a small amount of money if there is a movement in the market on either direction. So.
Okay. All right.
But yeah, I mean, it's very dependent upon how the market is and the liquidity available.
All right. Take that point, Puneet. Thank you so much for joining in today with your take and the outlook on the Indian markets and the sectors that you like as well. Time for a short break now. Pankaj Nayak from India Ratings and Research will join in next to discuss the recent report on unsecured business loans and how there have been some delinquencies there. Stay tuned.
Welcome back. There's a pretty decent rebound which is underway. It's just that there hasn't been follow-up buying in the last 1 hour. The rebound took place between about 10:30 and 11, and after that, markets have been largely stable around 25,300. But after yesterday's 2% fall, at least there is a green tick, and banks, that's the big segment in the market which is doing pretty well. Now, yesterday's market decline, though, has got people a bit nervous because the investor wealth which got eroded was nearly 10 lakh crore rupees. The Nifty also had registered its worst day in more than 2 months. Now, to understand the reasons behind the fall and what is the opportunity in this chaos and volatility, we spoke with Harish Krishnan, co-CIO and head of equity at Aditya Birla Sun Life Mutual Fund, and he believes there is serious money moving to China. Listen in.
Over the course of the last 2 quarters now, earnings have actually not gone anywhere for the broader markets in aggregate, even as markets have continued to climb up despite a poor election result, despite the capital gains tax and poor earnings print. So I guess it is some amount of normalization is what one is seeing. The second, as you rightly pointed out, is the function of what's happening in China. Year to date now, China outperforms the US, India in a surprising turn of events, right? 2 weeks ago, they were at 52-week lows. Come this week, they are at a massive 52-week high, outperforming almost all other markets. And this was a consensus sell, given various geopolitical measures and going into the US elections. And therefore, I guess some of the flow data that you spoke about, I think a lot of that has also got to do with the fact that there is some amount of serious money that is possibly going now towards China in the wake of a significant short squeeze that we've seen in Chinese market. So I think India is a low beta defensive market in the emerging markets. It typically does well when emerging markets flounder. It's like the FMCG of the emerging markets. So we think that there are 3 dark horse sectors out here from a 2-3 year point of view that we want to further add on to our positions. First is consumer durables. That's a space that we think has done quite well, but we think that there is more margin pickup story out there as a segment as a whole. Second is metals. I think we've come to a zone wherein the metal stocks have delivered quite well. The balance sheets are in very good shape. And I mean, of course, there is the Chinese stimulus angle, but even otherwise, I think that metal stocks are something where ownership levels are very low, and we would want to add on to that. The third is cement. This is a space where near-term earnings can look potentially disastrous, but this is a space where there is massive amount of consolidation happening. Again, a space where ownership levels are low, and that is something that we want to pick up into. On the sectors which were in momentum or which are in momentum and which can continue and where we want to add on and buy on dips, I would say IT would be high up on that list. We also think pharma is an area where we want to add on dips. Third would be capital goods. Fourth would be auto, and real estate selectively we would be looking at buying on dips. So these are the broad sectoral, sectors, kind of a footprint that we would want to buy on dips into this fall, in anticipation of creating greater value to our unit holders.
All right, that's a market opinion coming in. But with that, we'll slip into a short break. As we do that, here's some good news for our viewers. India's business news leaders now click away, introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC TV18 app now from the Apple Store or Google Play Store. Welcome back. You're still tuned into Trading Hour, and in its latest report, India Ratings and Research has noted that unsecured business loans are showing early signs of stress in asset quality. They believe this comes on the back of increasing competitive intensity, pressure on cash flows, and a lot more other reasons. There is a need to recognize the rising delinquencies. To discuss this and more, we are joined by Pankaj Nayak, the director at India Ratings and Research. Mr. Nayak, good morning. Thank you so much for joining in. Well, can you give us a sense of what are the early indicators that are suggesting that there could be pressure and there could be early signs of stress in the unsecured business loans?
Right. So, I mean, we have been tracking this segment for quite some time, and in our outlook for FY25, we did mention that this particular segment will see some kind of a stress because of some over-leveraging on the borrower side and also because of strain on the cash flows at the borrower's end. Some bit of aggressive lending by the NBFCs also is responsible for this kind of stress. So the early signs that we are seeing right now is basically incremental delinquencies have gone up, the write-offs have gone up, and the credit cost that is hitting the P&L has also started impacting the profitability. So I think these are early signs which we are seeing right now as far as the business loan balance sheets are concerned.
So Pankaj, you've laid out the reasons why we are seeing increased stress. But could you quantify the extent of the problem in the market right now?
Sure. So these business loan balance sheets or the P&L are designed in a manner that they have to absorb a certain level of credit cost. But we are seeing credit costs which have crossed that particular band. So the credit cost is in a range of around more than 5%, 6% odd. Now, more than 5 to 6% odd credit cost, which includes your write-offs as well as your provisioning, starts hitting your pre-provision operating profit buffers. And that actually impacts your profitability. And in many cases, the P&L ends in a loss. So that's the kind of impact which we are seeing on the P&L of unsecured business loan players.
And we already saw signs of that in the quarter gone by, in Q1. Many companies we spoke to, referred to the problem that you're talking about, this stress in unsecured lending. Has it become worse in the July, August, September? What is anecdotal evidence telling you about the recent months, the current months?
Right. So what happens is generally Q1 is a very lull quarter. Not a lot of balance sheet growth happens in Q1, because of which the top line doesn't grow, right? So whenever the balance sheet doesn't expand, all these problems start coming to the surface. And that's what we are seeing right now as far as the unsecured business loan is concerned, because a lot of income is getting generated by disbursing these loans by way of processing fee. So when you don't generate that income, obviously your top line is weak and the credit cost starts impinging on your P&L.
Pankaj, you said there is continuing pressure on cash flows in certain end user segments. Which are these segments where we are seeing the most amount of pressure, and is there any particular geography where we are seeing the most amount of pressure?
Well, the segments like food segment, textile segment, these are some of the segments that have come to our observation where we see elevated amount of stress. And if you talk about geography, then there is no one particular geography per se where we are, kind of observing this particular stress. It is geography agnostic, because there are quite a few fintechs which are doing this particular business. They don't have a branch-based model. I mean, they do it digitally. So a geography cannot be highlighted where these problems exist.
And how much higher are the credit costs in quarter 2 versus quarter 1?
Sorry, quarter 2 numbers are still not out, but the Q1 number looks very, very elevated as compared to, say, an FY24 number. So 3 to 4% credit cost has now basically gone into 5 to 6% kind of a trajectory.
And is there any, kind of a geographical, analysis to be made? Are there any particular, markets where we are seeing increased stress?
Well, there is no geographical trend per se, but it is more or less a pan-India phenomenon. And more or less, these entities generally, which are fintech players, they operate digitally. So, I mean, they themselves are geographically agnostic, when they do their lending. Sure. It's purely based on cash flow analysis and the basic data that they can procure digitally.
So because, this, the issue that you're highlighting, there will also be an impact on the growth under assets under management. The AUM growth will also get impacted. So what was the anticipated AUM growth earlier? And because of this stress, the fact that provisioning is now going up, what could be the decline?
Yeah. So these balance sheets were growing at a considerable pace. I mean, it was easily around 30, 40, 50% kind of growth that was visible as far as the unsecured business loan segment is concerned. Now, of course, that growth was happening on a much, much lower base. But if I look at the Q1 numbers, then a Q1 balance sheet size vis-a-vis, say, a March balance sheet size, it's flattish. It didn't grow much. Now, yeah, one may argue that Q1 is any which way is a lull quarter, and that's why there was no expansion. But it is also because of cautiousness practiced by the lenders, funding non-availability probably because of which the loan book did not grow, asset quality pressure which they are themselves seeing, which told them that they have to go slightly slow on that. So AUM growth definitely has taken a beating.
So AUM growth has taken a beating. What about capital buffers? Are they also impacted because of this? And what happens to the return on asset because of this? Is this something that could be a cause of worry going forward?
Yeah. So thankfully, the capital buffers are in a very, very reasonable band. All of them are operating in a leverage band of around 2 to 3 times, which is kind of an okay leverage given the retail nature of the balance sheet. But if I have to look at the AUM growth that has taken a beating, the return on assets under management, and here we have to typically talk about return on assets under management rather than return on assets, because a lot of business is generated through the off-balance sheet route. So the ROAUM, the return on assets under management, has actually become very, very flattish. So a blue sky scenario probably would generate a ROAUM of 2 to 3%. That is less than 1% now. Some of the balance sheets or some of the P&Ls are actually in the red. So on a console basis or on an industry basis, this is in a single-digit ROAUM band.
Okay. Last question before we let you go, Pankaj. You also spoke about some competition coming in for the segment. Where is it coming in from? Is it at an early stage, or we are somewhere in the middle and it's a little difficult for the institutions to get out of it?
Right. So repo rate started going up from May 22, right? It went up by 250 basis points odd. Now to maintain margins, NBFCs who are not doing unsecured also started doing unsecured lending, because that was the only way to protect margins, right? So because of which what happened is there was a lot of lending that happened in FY23, FY24, and these were the fiscals where there was a lot of pent-up demand because the previous fiscals were impacted by COVID. So FY23 and FY24 saw a lot of revival in demand that happened, because of which there was a lot of lending that took place, not just by the pure unsecured business loan players, but also by other traditional NBFCs who were not doing unsecured, but were only in secured products. So because of this, there was a lot of competition and heating up in the market. A borrower was spoiled for choices, because of which the over-leveraging also happened at the borrower's end.
Okay, we leave the conversation here. Pankaj, thank you very much for joining in. By the way, the Nifty is now pushing towards 25,400 and the Sensex has extended its gain to more than 500 points. So things are looking up. Stay with us. Halftime report will be up after the short break.